Hello?
Yeah, please continue, sir.
So, okay, yeah. I think the other issue which generally the banks face with the borrowers these days is about the leverage actually. So how much leverage can be there actually? But I think those are the general issues. But I think right now, if you look at it, what we are going through, the COVID times, there is a lot of stress in the market. There is a complete collapse of demand we saw for some time. The supply chains were blocked. The government came up with a lot of initiatives. The RBI also announced quite a lot of things. There was emergency line of credit. In fact, the banks proactively came up with the emergency line of credit even before the government or RBI announced anything actually, and the bank started giving about 10% of the limits to the borrowers. Then the government announced a lot of measures. The emergency line of credit of 3 lakh crore came in. RBI announced moratorium. There are a lot of things which are still going on. But I think the current times, there are a lot of issues that have been coming up now. How do you deal with this stress? I think that is where the bigger issue which is facing the banks as well as the borrowers. So this stress is not ordinary. This is probably going to be there for a long time. The stress comes on to the bank when you make available additional funds. Even when you do a restructuring, the banks have to provide for 10% on each of the restructuring that the banks do. There are balance sheets of the many banks itself are very stressed. They are operating on very low capital adequacy ratios. Their ability to provide even the 10% is actually a question mark for some of the particularly public sector banks. Second is that these days, even if you have to do some restructuring of a loan, how reasonable and accurate the forecast you can make at this point of time with the challenge I think the banks and the borrowers both are facing actually. I think maybe some of these issues we can discuss going forward. But my view on this relationship is that, the relationship is aligned. Both are on the same side and both of them want the borrowing units to succeed. The only thing is that there has been probably a little bit of loss of trust in the recent past. There is a need to rebuild the trust. I think the moment we are able to rebuild the trust, so this adversarial relationship, which sometimes we see, should not really be there. And both of them need to work together to see that, they can contribute not only to the success of the units, but to the economic growth of the country also. Okay, so we can maybe discuss the other issues later. You're on the mute.
Thank you, Mr. Gupta. That was a very good way of putting it. Thank you very much. I think there was some glitch in terms of us starting before the broadcast actually began. So let me give context again to those who, perhaps the early parts of this conversation got cut off. So when we started, we said that, look, the question was, there appears to be a gap between lending institutions and borrowers. And the question was, what is the cause of this gap that exists between lending institutions and borrowers? Is it is it something that the lending institutions have created, or is it something that the borrowers have created? And at that point in time, we had turned to Mr. Gupta, who, as the ex-managing director of India's largest bank, we thought he could provide us with some color. And Mr. Gupta's point of view was that there is indeed, technically there should be no gap between the two. Their interests are aligned. The adversarial relationship that we are seeing today is perhaps an aberration that has been caused by other factors, and Mr. Gupta is suggesting that we debate what those other factors are, so that once we understand the underlying causes for this, we can go forward. I have one quote to offer to everybody on the phone, or everybody on the webcast. Basically, as you're aware, banking business is an old business. It's not something new. And for a long time, there were proscriptions on, the charging of interest. It was somehow felt to be immoral. And in 1787, a gentleman called Jeremy Bentham wrote a book in which he defended the practice of charging interest. It is a book called The Defense of Usury. And in that he writes, the business of a moneylender has nowhere nor at any time been a popular one. Those who have the resolution to sacrifice the present to the future are natural objects of envy to those who have sacrificed the future to the present. The children who have eat their cake are the natural enemies of the children who have theirs. While the money is hoped for, and for a short time after it has been received, he who lends it is a friend and benefactor. By the time the money is spent, the evil hour of reckoning is come. The benefactor is found to have changed his nature and to have put on the tyrant and the oppressor. It is an oppression for a man to reclaim his own money. It is none to keep it from him. So Mr. Bentham seems to believe that there is a natural adversarial relationship between those who lend money and those who borrow. I tend to agree with Mr. Gupta in the sense that a bank should not be doing a loan to a corporate if they don't believe that their goals are aligned and that the corporate is also working towards returning the money together with interest to the lender. But having said that, let's turn to Mr. Narendra, who is also an eminent banker, who's been in this business for a long, long time, to perhaps give his views on why this adversarial relationship exists in the first place.
Thank you, Sheshadri, and thank you, Gupta ji Sahab. As mentioned by Gupta Sahab, that ASSOCHAM has been organizing this. This is one of the flagship program every year, and I think it is since more than 5-6 years. So always we thought that because I was also associated with ASSOCHAM, that it is always better for an interactive session between the borrowers and the lenders or the lending institution. I fully agree with Mr. P.K. Gupta's view that the very fact that more than 72% is the credit deposit ratio, I think average, and also the fact that at good period the banks have even grown their credit portfolio in a range between say around 18 to 25%, and also in the what you call the whatever growth which has happened in the Indian economy, there has been a role by the commercial banks in ensuring that credit that GDP growth. In fact, that the credit to GDP at the moment, that is another issue, that it may be 60-65%, and internationally that when you compare that is beyond 100 or more than 130-160%. So other day actually our Chief Economic Advisor Mr. Subramaniam was mentioning in the NIBM conference that the banks have to further increase their credit to GDP ratio. There is a very good scope, and they should utilize technology as the tool for ensuring credit delivery. And in the current scenario of COVID, it is this technology which has proved very useful for the banks, and banks never for a single day any disrupted their banking operation in the COVID period. And that because like State Bank, the other day MD of the State Bank was mentioning in another webinar, the 90% of the transactions are done through technology, and it is only for the 10% maybe they need the physical presence. So of course there are certain functions which can be done without the, or cannot be done without the physical presence, and the YONO, that technology done by the State Bank, and of course similarly some other such programs of digital banking or mobile banking or social media banking has also been innovated by the other public and private sector bank. That has proved that even credit delivery today, other than the deposit service and miscellaneous service, credit delivery can also be given. State Bank recently mentioned that they were able to give loan to the farmers on through this particular package. So whether it is MSME sector, whether it is a corporate sector, or whether it is a personal segment, or in the mid corporate, there has been a role by the bank. It is only in the recent days that there has been an incremental credit by the banks to the various sectors has been lower, and in the current year actually the bank has negative growth over the year end level, and year to year the credit growth has been around 6%, whereas the resource growth has been around 12%. So that also the fact that the Reserve Bank has given a lot of liquidity measures. There have been some surplus also have been placed with the bank as by deposit, that monies are going to the reverse repo where only 3.35. So this is in this regard that there may be a feel that banks are risk averse. But we have to also look back during the global financial crisis, when all the corporates and real sector needed the liquidity support. It is that bank which gave the liquidity support, so that the real sector do not get much affected. Because even though in globally it was a financial crisis, but in India it was most of the real sector crisis. Now, unfortunately, also that later part, there have been also some of those corporates wanted a restructure, and the banks, as per the Reserve Bank guideline, gave the restructure, and also the CDR mechanism, all that. But it so happened that in the same time, the banks also gave a push to infrastructure sector like airport, or maybe airlines, or maybe port, or maybe power, or such other areas, telecom or other areas, where some of that bank had not much expertise. So it is so happened that due to the regulatory and other environmental and other aspects, these accounts also showed some sickness. And but there are a few borrowers who are not so much prudent, and they are also maybe little what you call aggressive, and there are also a few who are not honest. So that has resulted in a large NPA, particularly in the public sector bank. And in the backdrop of that, there has been a certain what you call feeling that banks are not coming forward. But even for like a personal segment, now most of the banks shares are gone up to the personal segment, means housing and others, more than 20-25%. It was banks were never in housing. Today the public sector banks have done. So it has to be seen that fortunately that the banks have taken a lot of legacy measures, and the NPA level has come down to 8.25 as on March 2020, and the provision coverage has also gone up. So if that before even government could announce a lot of other measures to help the SME and other sectors, all the public sector bank, I think thanks to initiative of State Bank, that they gave an emergency credit of 10% of the limits to all the borrowers. Over and above that, the emergency credit guarantee scheme of the what you call the government for MSME up to certain guidelines, up to 3 lakh crore came, and banks would have dispersed 2 lakh crores. Now, it is to be appreciated that, but at the same time, borrowers, particularly different sectors, have different expectation on the bank, and those expectations have to be met. And banks are, as Gupta said, we are in the business of intermediate role, where the resources of the depositors, we have to take care of their interest also, are properly deployed and productively deployed as per the regulatory guidelines, and ensure that you create a small margin after all your operating expenses. Now this particular margin has come down, as Sheshadri has said, that Reserve Bank over a period of time, different methodology of pricing of the loans, and with that different methodology today, it has become linked to the what you call the 10-year yield or the repo rate. And with that, today most of the interest rates are very transparent and over and above the risk premium, which can be according to the rating of the client. So even on the pricing front, there cannot be any trust deficit. And even in timely availability of credit, now the banks have also developed so many underwriting standards. They have improved the process, they have improved their empowering of the people and the committee approach. With that, there has been a reasonable what you call the delivery has been what you call the time has been curtailed. Now there are the government and the that no, they take the initiative of online delivery of credit to MSME, yeah, in principle, and it takes within no time the in principle approval is given. There is also the TRDS, that is a online receivable funding, and so many such MSME and other customers can get at a market rate of interest, in a means very treasury rate of interest, these loans. So I think the channel financing, supply chain financing in most of the what you call specific area of finance, banks have to develop. Today in the forex area also, banks have developed technology in line with the foreign bank, and with
Narendra,
that yeah, please, in that all
sorry
the else, yeah, else
sorry to
everything,
interrupt. Let,
yeah, yeah,
let,
yeah,
let me just,
over, yeah,
no. I want to ask you a question.
yeah,
As a devil's advocate, we are skirting around the issue of the very high levels of NPA that we have in our banking system on an aggregated basis. The CIBIL has just sent out a report on MSMEs. They are showing that the medium-sized MSMEs, to a quarter of the portfolio is actually 90 days past due or greater, which is NPA, a quarter. Similarly, on the corporate side, last 2-3 years, we've had, a very large number of, very large quantum of corporates going bad. In fact, it's been a difficult period for the banking system as a whole. And I think it may be, it's appropriate to at least recognize the fact that, a little bit of this adversarial relationship is coming, perhaps on account of the failure of the borrower. I'm trying to, sort of be a devil's advocate here to try and inject, some this object into the conversation to understand how can we deal with it, because if we don't recognize it, then it becomes very difficult to deal with this problem. I mean, from a banker's perspective, as long as everything is going well, the borrower is his best friend. The moment something stops going well, the relationship automatically becomes a little less congenial, and as Mr. Gupta was saying, perhaps it even becomes adversarial at some point in time. So don't you think it is appropriate that we recognize that our borrowers haven't really kept their end of the bargain? Perhaps banks have also failed in some fashion, and maybe we can open it up and discuss the bank's failings. But definitely, given the numbers, it would be hard to say that everything is hunky-dory from a borrower's perspective. And the mathematics for the bank is that for every if they are making 200-300 basis points NIM, so basically only 1% of their loans can go bad on an annualized basis. Maybe 2% can go bad, because they have to meet their expenses also. Currently, banks are running at 10+% NPA, especially on the PSU bank side. So, how do we address that, Mr. Narendra?
Yes, sir. Sheshadriji, I agree that in the MSME, that recent report is the NPA level has come to 12.8%. So when we talk about SME, there has been also quite a lot of effect on the downward trend in the economic growth, or maybe delay in payments by the corporates to them, and so many other factors. Similarly, MSMEs are not having proper financial accounts, or some of the smaller were micro and all. Similarly, there may not be proper advice to them in terms of governance or in terms of transparency and all that. So in the MSME sector per se, we could banks have to have much more hand holding and give them awareness. And that's why recently, of course, that some steps have been taken so that how they can be put into the transparent model which I mentioned. As far as you rightly said, corporate, there have been because in good period they are very communicative, in the bad period they are not sometimes coming forward at the correct time, and after all the things have been done, and when the things are there raising their hands, then it comes to the notice of the bank. And as earlier VK Gupta said that it is a very big issue that some of the diversion and their various associate concern or related party transaction, or not having governance in the sense board level, better board experts or experts as a board member or independent member, or in terms of following the laid down rules of accounting, quite a lot of area it has been found that they are deficient. And in fact, quite a lot of commercial, particularly public sector bank, where had a higher exposure into corporate sector, and and it also been found that whenever such sickness comes, these the capital of these projects or capital of the promoter, that get mostly depleted, and he is not able to further bring in capital, and ultimately the account has become such a way that all the burden has come on the bank. Now that is how the so much restructure also resulted in what you call further NPA, because as it's also very difficult to project the futuristic their growth, and some of the whatever because it has got a lot of issue on their own company management, on the other economic factors, and the NPA level on account of restructure also had increased. So it is that currently, after bringing the Insolvency Bankruptcy Act, that has become a certain deterrent for the what you call these corporates. Similarly, the quality asset review and the further action by the Reserve Bank in identifying some of the 12 accounts or later some 30 accounts, all that. Now some of them are really had a better recovery prospect, but some had very bad, and our banks are also now taking action against the personal guarantee. Now that is also another deterrent. So we have a mixed results from the IBC, but this is a game changer. So I agree with the PR Sheshadri to the certain extent that one is that as such we also bankers could not visualize the complexity of certain infrastructure and certain projects, and we made our monitoring mechanism also not up to the mark. Now all those issues are now getting improved with the knowledge we gain. Now the IBA has gone with the empaneled list of chartered accountant leading firms who could be appointed as by the lead bank as a monitoring agency for some of the bigger accounts, and so that you get a timely report of the positive and negativeness of these accounts. And the banks would have also taken steps to ensure how to get alert when there are any diversion. Now as such that limited extent the borrowers should be honest, borrowers should be transparent, and borrowers should be always communicative, and they must trust the bank that in all times they will be with us in managing the company's performance and ensuring the viability and the quality of the account, in the health of the account. If such what you call that gap is bridged, I'm sure, because that responsibility is on both the sides, then we will achieve a ideal situation, which is now evolving, because now most of the government in corporate affairs ministry or the other various guidelines brought by the government has given a necessity like an auditor's role in ensuring the perfect audit, internal control, financial control, all that. Now this will give us fairly better reporting standards, and the study of the health of the corporate can be done. I think that will help in bridging the gap. Yes, Shadri.
Thank you, Mr. Narendra. That was a very comprehensive answer. I think you did agree that there were instances of the borrowers not keeping their end of the bargain, which also has led perhaps to this current situation where there is this gap that exists between the lenders and the borrowers. Is there? Let me turn to the non-bankers here. But before I do that, let me quickly turn to Mr. Gupta and ask him whether he has anything else to add from a banker's perspective as to whether, on this existence of this gap.
No, I think you said it right. See, as long as the going is good, I don't think there is any gap actually. I think the problem comes when there is a sign of stress actually. When a problem starts, and that is when this relationship actually starts turning a little bit of sour. Just two examples I'll say. See, one is that, when this NPA problem started in the Indian context some 4 or 5 years back, the banks did a lot of restructuring. RBI came up with a lot of schemes also, starting with you had CDR, then you had SDR, then you had S4A scheme. But if you look back and see that how many of those restructuring schemes actually succeed, not many actually. In fact, most of the restructurings failed. That is why the RBI recent past have actually not been coming up with any restructuring schemes itself, and they have been allowing it to the banks to work out something with the borrowers actually. So I think that is where the credibility issue comes in with all the restructuring or all the additional help that the banks have been giving. Second is that the government came up with a circular saying that all 50 crore and above NPAs, there must be a forensic audit done for all of them actually. So when these forensic audits were done for the accounts that earned NPA above 50 crores in the last 4 or 5 years, what we found is that in most of those accounts in the forensic audit reports, there were diversion, there were money moving out actually. In fact, if you read some of those forensic reports, they make horrifying reading actually. So what happened in the process is most of the large accounts were declared as frauds by the bank. Just the number of frauds declared by the banks in the last 2 years on account of large advances is a huge number. So that again reflects very poorly on the banks also, saying that about what kind of monitoring mechanism they had that they could not prevent these frauds. So that is where this relationship actually becomes a little bad. From the bank's point of view, I think the primary responsibility of the bank would always be to the depositors who have actually, reposed their faith in the bank, have trusted their money to the bank actually. The bank is supposed to take care of that money. The safety of that money is of paramount importance as far as the banks are concerned. So that is where I think the issue of conflict also comes in. So from the borrower's point of view, they must realize that the banks have certain limitations within which they have to operate also. So while dealing with any stress actually, so what kind of sacrifice the borrower makes, what contribution the borrower makes, and how much contribution the bank makes. Sometimes you find that it's expected that the banks will take care of all the stress. The moment stress has started, somehow it is the responsibility of the bank to respond actually, and there is very limited actually that the borrowers themselves can do. I think that is where again the problem comes in. But I think this we must keep in context when we talk about this topic. Okay.
Thank you, Mr. Gupta. Thank you for putting that in context. We also have Mr. Anand Sinha, who is the former Deputy Governor of the Reserve Bank of India. He's joined us. Mr. Sinha, if it is okay with you, we'll continue with this conversation, and we will finish at about 4:15 or thereabouts. And post that, could you give us your expert comments and special address? Would that be okay with you, sir? We can't hear you, Mr. Sinha.
Yeah, no, that is fine. It's okay with me. Can you hear me now?
Yes, we can hear you now, sir.
Yeah.
Yes, we can hear you now, sir. Thank you very much. Thank you. So let me now turn to the non-bankers here and ask them, their point of view. So far, the bankers have actually given a very balanced picture. They've not really said that this gap has come about only because of borrowers' point of view, but let me hear from the non-bankers as to what their view is. Would Mr. Kirit Mehta or Mr. Manocha, any one of them want to talk about this?
Yeah, I can.
Yeah,
Yeah, Mr. Kirit,
yeah, go ahead.
Yeah. Okay, go ahead. Yeah. Thank you, Mr. Seshadri. I'm very happy to join this. And among the all those who are experts in banking and financial services, but as a professional, I've seen how the financial systems have worked in India over last more than 40 years. So today, in order to be brief and focused on bridging the gap, I find that bridging the gap of trust between the lenders and borrowers. Now, it is very important to examine why this has arisen. Over the years, this has arisen, why it has arisen, and once we understand the genesis of its arising, why it happened, why it has reached this stage, then it is possible that we will get the answers of its solution from those reasons itself, So I wanted to repeat again that the failure or gap of trust is there because essentially, to begin with, people understand that there are defaulters. Because of defaulters, the lenders are affected and things have gone haywire for many, then the country, government, the depositors, everybody. However, to some extent, I will also say that one of the reason for defaulter is that many times when we see the businessman, the failure does not depend only on his on activities or lack of activities or expertise. There are outside implications. There are business vagaries, uncertainty, somehow or other competition coming in, his product becoming outdated. So there are reasons for failures, which may be genuine reasons and non-genuine reasons. But over the years, if we see last 30, 40, 50 years, what has happened that the banking institutions have lent money to the borrowers, but it seems that the entire system of supervising the borrower in a most efficient manner, maybe to my knowledge, it was not that well organized. In fact, in the initial phase, we had a ICICI, IDBI, IFCI as a specialized lending institution that also was later on removed, and universal banking was started. So one of the most important reason of arising the lack of trust between lenders and borrowers is that there was failure, there was defaults, and it was not very well supervised, organized. The funding was not that efficiently given. Technology was not introduced, and maybe there were not much of interaction between lenders and borrowers in a regularity, monitoring of the borrowers every month, and ensuring that looking at what is their current situation. So it was very important that one part is this, the efficient regulatory aspect from the lending institution itself in disbursement, in evaluation, in controlling, supervising, in taking reports. That is number one. Second thing it happened was that last 30, 40 years, what has happened? That if there is a failure and lender is in a good position to deal with the borrower, I find that there was no strong judicial system or regulations, or it turned out that judicial system was wrongly utilized by the borrowers to evade the strength or power of the bankers to deal with them, and they tried to probably to a large extent manipulate by the time bank is able to or lending institution are able to pounce upon them. So these are the two major reasons for developing the gap of trust between lenders and borrowers. And if we consider that if these two things are attacked now, which is being taken up by the government in last 5-7 years, which we see that a lot of changes are coming. But according to me, in order to analyze these solutions or possible steps that can be taken to find a solution for bridging the gap, I find that the reasons for arising the lack of trust is more important. And if we understand that, then in next step, when you take it up, the possible solutions to develop the trust, I would like to contribute at that time if this first portion is fairly understood and everybody has shared his views on that particular aspect. That's what
Thank
I
you.
feel. If you permit me, then we can wait for the next step of any solutions.
Thank
And
you.
how we work. Yeah.
Thank you, Mr. Mehta. Now, I think let me rephrase the question. See, I am also a banker, and I used to work overseas. I came back, and one of the strange things I found here was that business people would come to me, and when I was running a bank, and tell me, "Look, my business has grown, so now you have to give me more working capital." In the outside world, those kind of conversations never happen. Here it looks like a businessman thinks that it is matter of right, that there is a working capital gap and it needs to be financed. The expectation is that the banker has to step in and find the money. So I'm deliberately trying to be a little provocative here so that the non-bankers can put their point of view across as to what are the issues with the bank which is creating this gap of trust. let me sort of elaborate. One of the things I used to work, most of my life I worked for Citigroup. In Citi, any business that was growing very fast, we would not finance, for the simple reason that working capital requirements will keep increasing, and the moment you give 1 rupee, you will be on the hook for the next 1 rupee, and then you'll be on the hook for the next 1 rupee. So we wanted boring, dull businesses that were growing, at a reasonable pace, where internal accruals will take care of incremental working capital needs. So what is the borrower's perspective? What are the issues with banks? What are they seeing? So that we have a composite picture that we can then use in the next part of this conversation to find answers to this problem. So may I turn to Mr. Dubey, who is, very patiently been listening to us. Mr. Dubey. We can't hear you, Mr. Dubey.
Dubey sir, you are on mute. Please unmute yourself, sir.
While Mr. Dubey is trying to figure out how to unmute himself, let me turn to Mr. Sharma. Perhaps Mr. Sharma, you can answer that question, and then we move back to Mr. Dubey.
Yeah, absolutely, sir. I think so. First of all, congratulations to ASSOCHAM on organizing this webinar on very what I would say need of the hour topic. My humble regards to the panel out here as well. Since the very starting of this webinar, so we've been discussing about that. Yes, there is a trust deficit among the borrowers and the bankers. Now, what I feel, as a fintech company, I can add from a technology standpoint where we come from, that this particular trust deficit which today is arising, that it's a multi-layer. It varies between different sectors of the bank. Now, spanning from retail going towards MSMEs and mid corporates and large corporates is fairly, what I would say, differently impacted with the current scenario as well, and due to the what I would say some gaps which by default are existing in between the system. Now, as a technology provider, what we've been trying to envisage more on is that technology is something which can definitely help to bridge this gap, because when you talk about bridging the gap, you need to improve your communication and you need to improve the access to banking facilities to the borrowers and access of borrowers to the banks. So I think that is something where we have been trying to work around. And with the given point of agenda from the government as well, where the emphasis is more on using different types of technologies to evaluate products and businesses more in depth, is something which we are working on. The banks nowadays are also intelligently changing themselves. I would say that they are very seriously gauging their customer base and adopting to different types of technology methods. Now, when we talk about technology methods, there can be different ways of doing this. One is to strengthen your internal systems with respect to your current presence. Second will be to innovate to different solutions so that your reach increases to the market. Now, these innovative solutions, now a lot of banks have come up with their own digital lending platforms where it is making life of the borrower easier to go and ask for funds. Now, as Mr. Seshadri correctly mentioned that while he was working overseas, there was never a question that when the business is growing, why there is additional requirement for a working capital. So basically, these type of use cases involve an in-depth understanding, using different types of systems, which now in India are gradually growing. So we also support algorithms to the banks where the banks can do a deep scrutiny of the business and understand, what is the reason of an exponential growth, or I would say, a moderate growth from that matter. Now, this becomes a win-win situation for both the bankers and the borrowers, where at least there are structured products and there are structured evaluation techniques being laid up. it is not that the borrowers are left in silos, that they do not know how they are being evaluated. Now is the time where borrowers are more intelligent with respect to understanding the credit policies of different banks. So I think the need of the hour was definitely to set up more technology setups with NBFCs, with banks, and I would say NBFCs on the other part has been the front runners in adopting technologies. That is the reason their reach has increased today. And I think how the government is also planning to bridge the gap between the orthodox lending institutions and the borrowers is basically from the ways and means where likes of like co-origination lending models have now started erupting a lot. Now these models will certainly benefit the market as a whole, where the borrower needs the bankers to come and give them the access to the fund which they require, and on the other side, from the bankers side, evaluate the borrowers from a point where the bankers want. So this was more from the liability side, I would say. But again, an important point which was made by Mr. Narendra was on the monitoring of different types of customers in this current scenario. Now, with respect to monitoring also, I would say that technology has given a robust boost to the bank with respect to how to assess a borrower once the credit has been delivered to the borrower. I think that in turn increases a lot of trust between the borrower and the banker, where if the bankers are able to, what I would say, devise intelligent methods to monitor the borrower so that the borrowers are also intimated on time. Now, the more we improve the situation of a post disbursement structure in today's banking system, I think the more is a trust which we can have, and that will something which will ensure long-term relationships between the banks and the borrowers.
Thank you, Mr. Sharma. You're basically advocating a technology-led solution that will enable better communication and therefore bridge this gap in some fashion. If I'm, paraphrasing what you've just said appropriately. We've lost Mr. Dubey, it appears. So let me turn to Mr. Srivastav. Mr. Srivastav, can you talk to us and tell us instances or how you think banks are failing their customers? Mr. Srivastava, we can't hear you. Mr. Srivastava, we still can't hear you. Let me turn, Mr. Srivastava, while you attempt to do this, let me turn to Mr. Manocha, who's, I think, got his microphone on. Mr. Manocha?
Yeah, I think it's on. Am I audible, sir?
Yes, we can hear you. Yes, please go ahead. Please go ahead.
Shishadri sir, am I audible? Yeah, first of all, let me thank you, sir, as well as ASSOCHAM to bring you on the panel and discuss this very important topic. I'm not audible?
You're audible, Mr. Manocha. Please go ahead.
Now,
please go ahead. Yes, you're audible,
yeah.
Sir. Please
sir,
go ahead.
I'll touch upon certain issues why there is a trust deficit. Yeah, okay, sir. Thank you very much, sir. Thanks for giving the opportunity. And as Mr. Gupta also has mentioned, and also Mr. Narendra, that basically until as you, it is in the bank's interest that they should do the business with the borrowers. But still there is a reason then trust deficits comes up. And you also raised the point of working capital, like when there is a working capital requirement of the borrowers, the banks are asked to fund it to the borrowers, and then why suddenly there is a trust gap, trust deficit when the business for both of them. Sir, am I audible, sir?
Yes, Mr. Manocha, you are audible. Please go ahead. Please go ahead.
Okay. So basically what happens, why there are certain, I would just touch upon some of the genesis why this problem has happened. Over the last 30-35 years, actually, I'm earlier banker also. Now I actually deal with the banks for various because I'm in the merchant banking, investment banking. So I interact with borrowers as well as with the banks. So with my experience, I can tell you what are the actually reasons why this all is happening. So definitely every time, if you see in 1990, when you go back to Harshad Mehta's time, there was a nexus between some of the banks as well as some of the flagship people like Harshad Mehta. So this resulted into problem. So this result, when such problem comes up, so suddenly there is a CBI inquiries, and there may be certain reasons that when the bankers are also asked to put to difficult situations, even though they may not have any role in that, but they are put to inconvenient questions. So because of which there is a risk aversion develops over a period of time. Not that necessarily that people, those who were involved in the system, but other people who were in the process, they also get actually all these bombardments from the questions from CBI and other investigating agencies. So this actually makes them risk averse. And apart from that, there is the system itself. This, like when you talk about the working capital issues, basically what happens, even the methodology of the bankers are sometimes so difficult. Like, so I deal with the banks. If any particular has to go beyond a certain amount, say 15 or crore rupees, it has to cross so many layers. So from branch to zonal office to head office, and then again the approval also will come in the same way. Particularly I'm talking about the PSU bank. I'm not talking about the private sector banks. PSU bank. So it goes in the same chain and comes back in the same chain. By the time patient is already on the oxygen, so by the time actually you get the approval, so there is some problem. If there was no problem develops, and if there is a problem, it becomes non-solvable problem. So actually this creates a lot of trust deficit between the even borrowers also. They are uncertain what will happen to today on, with my approvals, with my project. And apart from that, the working capital point which you raised, there are two issues, sir. One on the banker side, one on the borrower side. Let me touch upon the banker side. So now our system is such a system whereby you need the audited reports. Until you get the audited reports, you will not start the assessment for the year. Audit report comes sometime in the month of September only. And now during this kind of crisis, or every time government and gives extension by 1 month or 2 months. So invariably, audit reports will come in the month of September or October. By the time audit report comes, they start doing the process, lead bank will process, and by the time the process is done, approval will come in the month of February, and for the same year. And then how can a borrower can actually complete the entire projections for the full year when only 1 month is left? So this cycle actually is very prominent. There has to be some structural changes are required, that instead of audited report, there should be some mechanism where you can do either for 2 years at a time, so that there is no problem for the next year assessment also. Otherwise, this problem is going to continue. Now let me touch upon on the borrower side also. So working capital in India is such a big problem, whereby every time I get for a new assessment, I get the assessment done based on my working capital, either stocks and receivables. And in India, particularly, there are a couple of sectors like steel sectors, like commodities. Now you appoint the stock auditors, bankers appoint the stock auditors to weigh the steels, to do the steel. So in India, unfortunately, there is no way to actually weigh the stock lying at the premises of the borrowers or factories, big factories, particularly in steel. What happens? You have a tendency, particularly whenever there is a diversion of funds from working capital, because again, there is a perennial problem in India, because we want to do based on the collateral. So every promoter is actually tempted to take out some money and create properties, take out some money from the working capital. So when the working, that kind of thing happens, so what happens? Either it goes out of the receivables or it goes out of the stock, and there is no way that stocks are actually verified by the stock auditors, because nobody has got the competency to lift the stock at that point of time and weigh it and tell. So this perennial, every year on year, people keep on increasing the stock value and requirement value and they keep on working capital requirement. This is a big problem in India. So basically what happens in this case, the situation is this, solution is this. Generally, you appoint an auditor and statutory auditors. I actually like Mr. Kirit Mehta. I will actually come for the solution maybe in the later case. Let me tell you, highlight the problems. So this is another problem. Process
Mr. Manocha, we are in the interest of time. Mr. Manocha, may I request you to be brief because we are, we are running against the clock.
I'll touch upon a couple of other issues also. Like there are a couple of things which are processing driven. Like what happens today, we actually assess the any kind of requirement, be it working capital, be it term loan, basically on the basis of the projections. Now what happens? Projections are ought to go wrong sometime during the course of the project or during the course of the life cycle of the company. But what happens? Any time any projection go haywire, everybody is actually asked to bank managers or the senior people are actually asked to inconvenient questions. So this is the problem basically in India, because otherwise what happened earlier, one-time restructuring was allowed, but somehow when Dr. Raghuram Rajan was there, so he has actually said that one-time restructuring. In fact, Mr. P.K. Gupta also highlighted the point that this system of EQRs etc. has actually caused a little bit distress also, and likewise one-time restructuring was made NPA kind of show. If supposing I go for the one-time restructuring, it would be considered as an NPA. This created a big resistance amongst the bankers not to take up any genuine requirements also. So this all has created a actually trust gap between the borrowers, whatever actually if they will go for, and if they highlight the things properly, so ultimately they are not going to get the solution. So as a result, there is a they would try to hide the things. On the other hand, bankers also have lost the trust because there have been many instances. Just take from 1992, Parshit Mehta, then Ketan Parikh, and then Satyam in 2009, when actually they were actually shoring up their books just to get more and more working capital from the bank. Likewise, then came in 2010 another scam, then came hedging scams, then thereafter came in way back in 2018 this Nirav Modi, Firestar. So all these things actually have created a lot of trust deficit between both of them. Today, bankers are actually averse to taking any decision, because if they take any decision today, they can be asked tomorrow, or maybe even after their retirement, they will be put to the questions by enforcement agencies. So there is a big problem in the system. You need a deep structural reforms. Deep structural reforms can only happen when some steps are taken with the view to actually execute it properly. Intentions are good. Government has taken various steps actually, but what happens? They are not taken full steps. Like in IBC, I give you one example. Insolvency and bankruptcy code actually is a very good solution. But what happened while implementing? Government has done the IBC right straight, but what happens? They have made only one person who passes the exam. He is there to take over the assets and also solve the problem. Actually, instead of that, they should have brought in some corporate structure also, where IBC could have been involved, big corporates, and they would have actually given the taken up the issue. So intentions are there, but some kind of implementation, execution problems are there. Government directives are there, and we need to define. Bankers also have to get the full. Now another problem which I see, why this trust deficit gap is widening, because of this crisis and because of other 2-3 years. Just 1 minute.
I'm sorry to interrupt. In the interest of time, if you could keep this brief, sir.
Only 1 minute. I will take 1 more minute. For the last 2-3 years, what is happening? Because the economy is going through various problems, and thereafter this crisis has come. So the trust gap is widening because of the situations problem also. Now, because we are actually encompassed and empowered with so many problems, because of these problems, now it is very difficult to take the right kind of steps. But yes, over a period of time, I think we need to sort this out. We have a solution also this, but maybe afterwards I'll touch upon this issue.
Thank you, Mr. Manocha. My apologies for interrupting you there. May I turn to Mr. Dubey? Mr. Dubey and Mr. Srivastava, maybe Mr. Dubey can go first. From your point of view, what are the banks doing wrong, which is creating this trust gap? Mr. Dubey, we can't hear you. Mr. Manojam, may I request you to put yourself on mute? Mr. Dubey, we still can't hear you. So,
can you hear me now?
Yes, I can hear you.
Hello. Yeah, fantastic. So the technological glitches using Apple, and this is where I was trying to get in between Chrome and Apple, and a lot of gaps happening. So, anyways, a very interesting discussion. At least I could hear everything that was being spoken. So what I want to share is, the experience of the borrower here is, there are a large number of borrowers who are looking at getting funded, but unfortunately they are not able to reach the right place, or even when they reach, they don't get the kind of funding that is required. And I would like to share, a small quote, which is like, we have all heard about it, ki doodh ka jala chhaj bhi phunk phunk ke pita hai. So because of the people like Nirav Modi, or because of the people like Harshad Mehta and others, and when we are analyzing that, there are people, companies who have already a lot of funds, it's easier to fund them, and we give them more funds, and that is where the trouble happens. Whereas for the overall economy to grow, whether as a banker or as a borrower, the responsibility of each one of us is to grow the economy as such, to grow the total welfare of everybody. And that is where the role of each one of us comes, so that when we are funding or we are taking money, both ways we have to be very flexible, and we have to keep that in mind, that we are doing it not just for ourselves but also for the economy to grow. And therefore, yeah, honesty is definitely very important, and we have to have a mechanism where we have to see that our money, which is our own customers' money, we should not give it like free and it get lost. But there has to be checks and balances, but it should not be only to the top few. It should be to a large number of people who are innovative. And we have to know that when innovators are starting, they may fail, they may have a trouble. We will have to make a mechanism and support those innovators who are becoming first-time entrepreneurs or second-time entrepreneurs. And we know that many of them would fail, but still, how can we support them so that they come back and become successful? If we see the stories of all successful people, most of them have failed initially. And this is the initial time where, India has so many youngsters today who want to become entrepreneur, but they are not able to reach to the right institution to getting the funds. They are brilliant ideas. They're moving around, and there are people who are just talking to them, misusing them, but they are not able to reach. That is where I have a concern that, there are very senior bankers here, and I understand that you have faced a lot of challenges, but we have to see that we have to develop, for the development of the overall country, we have to give this small SMEs and a support where we know that the default rate might be more, but then you can have a differential strategy for a higher interest rate perhaps, so that you mitigate that and you give more and more funds to a larger number of people, so that more organizations can grow. And we have a large number of youth who are jobless because of the problems that we are facing today, or we have been facing in the last few months. And as a result, many of them want to become entrepreneurs, but then only one thing is getting stuck, and which is where to get the money. I just started a consulting company, and we are helping startup companies in India, globally as well. And my expertise doesn't lie in lending money or getting money for anybody. I have sales, business development. I was a CEO for a large multinational company, so I have those expertise. But I was surprised that when people approached me, 90% of them were just seeking money, and they didn't know where to go. And most of them were only private, not the banks, because of the certain conditions that have been put that they can't start. So there are a large number of these entrepreneurs who really want to grow in life, but they are not seeing the money. And that is where our responsibility has to be. And we as banker have to open up our mind to look at how we support them, because otherwise the youth of the country will go into a direction which we will not like. So therefore, what changes we have to make at this point of time, we have to look very seriously on that.
Thank you, Mr. Dubey. That was a very helpful comment. So basically, if I may paraphrase, I think the panel here is of the view that the borrowers have not held up their end of the bargain. As a consequence, there has been a large amount of NPAs that have happened over a period of time. There have also been large frauds and so on and so forth. At the same time, the banking system's processes have not helped either, because as somebody mentioned, it takes months and months and months for approvals to come through, and it severely strains the business and puts pressure on the business, and probably leads to some form of sickness coming through as well. So clearly, both ends of the spectrum are at fault. Clearly, if the system could resolve some of these quicker, one must remember that good borrowers or people who are paying their installments is bad ones. So protection provided to those who are not keeping their end of the bargain effectively increases costs to the good customers, has to be kept in mind. And if there is, at this stage, if we could, think of methods by which this gap can be bridged, maybe that would be helpful. Let me turn again to Mr. Gupta as the senior banker in the room.
Mr. Seshadri, are you able to hear me?
Yes, I'm able to hear you.
Yeah. So can I speak a little bit on this also? This is Ankur Srivastava. This is Ankur Srivastava.
Mr. Srivastava, yes, please keep yourself brief, Mr. Srivastava. Thank you.
Yeah, sure. So thank you, Mr. Seshadri and ASSOCHAM and senior members on the panel. So different views have come, something on the bank side, something on the from the borrower side. So different issues are there. It's not that every borrower is a thief, and it's not that every borrower will go run with the money. And we have to find a midway somewhere. If you see over the period of last couple of years, maybe almost a decade, lot of entrepreneurs are turning towards the private equity, private finance, etc., compared to the banks. So the traditional industries, traditional sectors are still going to the banks, but when we talk about the big startups or big companies, suppose we take a case of a Flipkart or somebody, they are not coming to the banks. They are raising the money in the international markets. They are going there. And even there, in these companies or the startups or the new age industries, there have been default, there have been the losses. But the investors keep their faith. They try to recoup the money. They can't do the things. Vis-a-vis, when we talk about the public sector banks or bank per se, it's more a public money, where a banker which is there, it is not his money. He is relying on certain things. He is subject to CAG audits. He are subject to various audits. And whenever the incidents like Harshad Mehta, like somebody said, or the Nirav Modi, or even if we see last 5 years, who's face of the industry, whether it's a DHFL, whether it's the ILFS, who are the biggest name in the industry, have all gone. So one of the biggest issue where I see is the governance structure in the borrowers, where the bankers initially do all the financials, audits and everything, governance which is missing. And this is one of the sector, I think last couple of the year, RBI has also tried to put it on the governance issue of the borrower, because that is where the entire structure come into. Secondly, when we come with the various schemes like S4A, CDR, etc., even now the IBC, the desired results are not coming. Even during our some earlier discussions also, I suggested like there is a model in the Malaysia, that Dhanantara Bank, when the mid-90s crisis happened, where a bad bank was created. They were taking the loans from the different banks at certain things, and if the bank doesn't want to sell that asset at that price, market value, they have to make the higher provisions. Whereas if this Dhanantara bank sell this asset at a higher value, they have to pay back 80% to the public sector, to concerned banks. So some sort of a model we have to derive as a body, as a CHAM. We have to suggest to the government can be a lot of blame game. There is obviously a trust deficit between the banker and the borrower right now. But the topic as suggests we have to come with the solutions. And one of the solution is that we have to educate more borrowers. We have to ensure a better governance at their structure. And then now with the advent of the GST and other things, one of my colleague panelists was talking about the stock audits. Now with the GST and everything, it's very become easier for a banker or any auditor to cross check what are the actual sales figures are there, what is the GST returns are there. So we have to use that, take the use of the technology to have a better vigilance on the borrower's account and move towards helping them as a friend rather than. And as a banker, I am also an ex-banker, and we see that some of time delay in decision making certainly lead to the, apart from other reason, making the project very overrun, and that may lead to the NPA. So these certain things we have to look into.
Thank you, Mr. Srivastava. You made some very, very important points, essentially saying that we need to move forward instead of, trying to apportion blame. We need to find solutions for it. And one of the things that you mentioned is that improving the quality of governance, improving the quality of information, and I'm sorry, I'm getting some feedback which is making it difficult for me to continue. Can you put yourself on mute, those of you who are not on mute, perhaps? Okay. So let me turn to Mr. Gupta now and ask him as to his point of view on how this can be bridged. Mr. Gupta, in the interest of time, may I request you to be really brief because we are running significantly behind schedule, sir.
I think just 2 points before that. One is we're talking about the funding of startups. See, generally, as of now, the banks don't fund the startups because we're not sure whether it's within the bank's mandate to take that kind of risk. As Mr. Dubey said, that they are prone to failure. So those failures are not the risk typically the banks take. They are funded by private equity. They are funded by angel investors. So I'm not sure that the banks in India are actually ready to fund the startups by giving them the loans. Second point, I think Mr. Seshadri made, and I agree with him, is that in India the system of cash credit, I think, is responsible for this somehow impression being created as if the banks have to be there to fund all the growth in sales or any kind of issues that happen, and somehow cash credit account needs to take care of all the borrowing requirements of the customer. So maybe the more we move towards the other systems of funding by means of a working capital term loan or the normal modes that are used globally, I think in India probably that impression will go away. If a borrower needs more funds, let them approach and ask for that facility rather than having a cash credit limit which somehow seems to take care of all the requirements. I think in terms of suggestions, I think there are just 3. One is the trust. I think the trust needs to be built both by the banks as well as by the borrowers. And once the trust exists, I think so these kind of issues will simply disappear. Second is the transparency. I think there the borrowers need to play a much bigger role. They need to become much more transparent with the banks. Actually, banks should be able to rely on all the information that they get from the customers. They must get the information in time and then be able to take decisions based on that. And the third and the important thing that is already happening is on the technology. I think more use of technology will take care of all of these issues. A lot of this is already happening in the country. Even for the smaller MSME loans, like 59-minute portal which the banks had built, which is able to convey sanction online. I think it's already working very well. So if a loan gets rejected on the platform, I don't think anybody minds that. You have the TREDS platform that has come in for the bill discounting. You have the GST, which is now making available all kinds of data to the banks based on which decisions can be taken. Cash flow based funding, I think, is the way forward, which can take care of a lot of these issues also. I think more and more use of technology, artificial intelligence, machine learning, less of discretion based funding, more of technology based funding, I think will take care of many of these trust issues. So just the 3 T's, I think the trust, transparency, and the technology should take care of this going forward.
Thank you very much. Very epigrammatic. I mean, TTT, trust, transparency, and I'm sorry, sir, what is the third point? Technology. Let me just ask you one more question, just to be, one of the things that we used to do in Citi was to try and figure out how to get out of the loan. The ways out, as we used to call it, before you get in, how are you going to get out, was a more important question to be answered. In the Indian context, do you think that the system allows you to get out of a loan as a banker speedily enough? Because if things can happen quickly, then some of this trust deficit related issues, you would agree, can be reduced.
See, I think that is the problem typically the public sector banks face. See, the thing is, if your exposure in any account is small actually, so then probably at times it is possible. Now, what is happening is for the last 2-3 years, most of the banks in India have been putting in place the early warning systems. So what we are finding is from the early warning systems, many times you're getting signals that, okay, this account is not performing, maybe we need to get out actually. But what we found in SBI particularly was that generally our size of exposure in most of the accounts will be so large that the moment SBI says that I want to get out, I think all the other banks will get out even before we make the first move actually. I think it's very difficult for the banks to get out. Any bank giving even a signal that I want to get out actually, I think is very, very difficult. But we need to get to a stage where we need to create a market in the loans also. I think the RBI set up a committee sometime back recently on the secondary market in loans also. I think some work already been done on that. I think once that happens, then maybe it may be possible for the banks to get out. But even with the best of early warning systems that the bank can put in place, when you know you want to get out of the account, but I think in India it's very, very difficult practically to do so.
Very much, Mr. Gupta. That was very useful. So the banker is wedded to the customer, so it's very difficult to get out once you get in. So let me now turn, in the interest of time, to Mr. Mehta. Mr. Mehta, you have precisely 1 minute. How can we bridge this gap? Mr. Mehta, we can't hear you.
Yeah, may I? Yeah. I find that there has to be much more interaction and follow-up between the lenders and the borrowers, understanding each other, understanding the current situation. And if the lender use the data analytics, which is now fairly available, and fintech and IT technology are also very efficiently available, one can use it, the lenders can use it, and can certainly understand the borrowers much better, and either they can take quick action, or alternatively, after understanding the borrower's issues and problems, then can facilitate further funding after going through the true realities. So this is what is very important. Data analytics, follow-up, interaction will certainly improve the gap of the trust between lending institutions and borrowers, and this is what is my suggestion.
Thank you. Thank you, Mr. Mehta. Mr. Sharma, what a 60-second brief on how the situation can be remedied.
So I think now that we've agreed to the 3 T's as explained by Gupta sir, so I think that should be our way forward to take it from there. And I believe that the fintech industry as a whole is continuously striving hard, and as point mentioned by Mr. Mehta on the data analytics side. So companies like ScoreMe and others in the market, we are doing constant efforts to make things more seamless for the bankers and for the borrowers as a whole. And I think once we reach towards that equilibrium where the borrowers and bankers are accepted onto technology, I think that the way forward will be very drastically different from what we are seeing today. And we can certainly expect a better trust to enhance between the bankers and the borrowers.
Thank you, Mr. Sharma. Mr. Manocha, 60-second brief on how can we remedy this problem. Mr. Manocha, we can't hear you. Mr. Manocha, we can't hear you.
Yes, sir. Am I audible now?
Yes, you're audible. Please go ahead.
Sir, most of the points have been touched upon. I will touch upon only 2-3 points. One is, as far as the addressing the working capital is concerned, I mentioned that 2 years assessment should be done. That is as far as the working capital thing is concerned. Then I think bad bank, like Mr. Srivastava has mentioned about Malaysia, the Hanatra, I think that is a very good idea. Actually, government is already moving on this idea for some time. This should be actually completed as fast as possible. Apart from that, there is a one very important decision which MPC has recently taken. That is for gradually shift from entire working capital to working capital term loan. I think 4 months back, they actually decided that at least 20% or 25% should be in the form of working capital term loan. That should be gradually increased to 50% because the dependency on the working capital has to be gradually reduced because that is main root cause of some kind of problems, also big problems, particularly in the tech industry. And last but not the least is one fintech is playing a very important role in standard products like small personal loans, housing finance, etc. Likewise, wholesale product also there should be some objectivity should be created by the technology so that the banks reliability on that goes up and the risk aversion comes down because ultimately the answerability of banks on otherwise is actually the one reason which keeps the bankers at bay from taking decision. So I think this I would say these 4 or 5 things if are implemented, the trust will be built up automatically.
Thank you, Mr. Manocha. May I now turn to Mr. Srivastav?
Are you able to hear me now?
Yes, I'm able to hear you. Please go ahead.
Yeah. As Mr. Manocha has said, the solution lies that one, the bankers have to make their decision making little bit quick. They have to adopt to the changing scenario in the market where there are a lot of private equity investors and funds, and now they may be dealing with the more youngsters entrepreneur rather than the traditional industry. In the times to come, a lot of SMEs are coming up where the new peoples are coming, and unlike the scenario where the earlier one generation before the entrepreneurs were thinking in a different way, and now I think the youth has changed, and with a lot of I can give you an example right now with the GST and income tax is almost interlinked. So what are you are filing your return in the GST, the same can be see from your returns. And one of the things the banks actually can do, rather than seeing the due diligence of the companies, they should do the due diligence of the promoters. How many assets they have created, how many banks account other than their informed bank accounts have been created. So these sort of information can be found out. And like the IBC is there, the other thing is there, and certain bad bank or something can be created, and the banker should be not fear about the action to be taken after even their retirement, which is I think the biggest thing. When the CBC, CBI, I have seen even the retired MDs or EDs of the bank after even 10 years of retirements are being called for their decisions taken through a committee manner. So those things has to be taken, and a more robust monitoring technology based can be introduced.
Thank you, Mr. Srivastav. Thank you. That was very useful. I think you're reiterating what the others are saying. May I ask Mr. Dubey, whose connection seems to be paused at this point in time, whether he has anything to add? 60-second brief on how this gap may be bridged. Mr. Dubey doesn't seem to be here. So let me paraphrase in the interest of time. Essentially, to bridge this, one aspect that Mr. Gupta mentioned was perhaps to look at an alternate structure as opposed to the open cash credit that we currently use. Something to purchase, to finance the purchases of raw material and other goods that the business has to have. So a purchase finance section, the sales finance, so purchase the sales, to finance the sales. And third is a small quantum of OCC that can be used to meet ongoing requirements for a business. So the structure of the loan itself can be changed is one suggestion that came through. And there were a bunch of other suggestions on improving communication, on using modern technology, on relooking this whole thing about doing stock audits, etc., and using other information sources to actually do a continuous audit of the stocks. I think that is what was suggested. So with that, let me thank the panel for a extremely useful discussion, very, very enlightening. There was a lot of debate. I think we started by saying that the goals of the two institutions are aligned, which is basically the banker and the borrower are on the same side of the table. Then we realized that there were issues that had cropped up in the past which had led to this situation, and there were also constructive discussions on how this can be addressed. So with that, let me thank all of you once again for being here today. Let me request Mr. Sinha, who has been patiently listening to us, to give us his expert views on what can be done to resolve this problem. Over to you, Mr. Sinha, and our apologies for overrunning by about 15 minutes.
That's fine. How much time I have?
Sir, we had scheduled to close this at 5 o'clock, so you have 31 minutes by the clock.
How much? No,
31 minutes.
No, not entirely. To myself, how much time I have?
Sir, it is up to you, sir.
No. We have to abide by the time. So let's say if I take 15-20 minutes, is that fine?
That is fine, sir. Please go ahead.
Okay. So, Mr. Seshadri and other panelists have been, and all the other participants, it has been very educative for me to hear all the panelists and their viewpoints regarding how to bridge the gap between lending institutions and borrowers. I am not a person with my ears to the ground, so obviously the inputs from the practitioners is something which I don't have first-hand experience of. But nevertheless, I would like to add a few points on what has been discussed, and then talk in general about the situation today, and that is more from a macro perspective, from a wider perspective of what is the situation today and in what direction we should be moving. So now when it comes to bridging the gap between lending institutions and borrowers, one point which I would like to mention, and I think that is where a whole lot of banks, particularly the public sector banks, went wrong, was the issue of information asymmetry. A borrower would know much more, no matter how smart a banker is, about his activities, about his projects, than a banker would. And therefore, the first requirement is that this gap should be narrowed as much as possible, which means the banker has to be knowledgeable, very knowledgeable about what he is handling. And that is where many things went wrong. And this was one of the reasons for the rise in NPAs that we are seeing, of putting their hands into complex infrastructure projects without having any expertise. So, and it is also important from a practical perspective. If the borrower has a sense that the banker who is lending does not really know the ropes, then he is more likely to, he will be inclined to, unless his ethical values are very high, he will be inclined to take the bank for a ride. So a banker, I'm not advocating that a banker should be suspicious, but he should not be naive either. And that is where the importance of not dealing with issues or not dealing with projects or subject matter where adequate information and expertise is not there. One must guard against that. The other soft issues are about ethics and empathy. Ethics is very important. In fact, in the wake of the global financial crisis, a lot of regulatory work and attention has gone to culture and ethics in banks. And it is equally true for the borrowers. There has to be a return to ethical values and proper culture if we want the system to really function well. And as far as the banks are concerned, this message has to percolate from the top. The third issue that I would like to talk about, and a lot has already been talked about, is about the use of technology. There is absolutely no doubt that technology is the key if we want to improve our underwriting standards. And in fact, there is a lot of academic studies and evidence that the models, the credit scoring models used by big tech companies, based on the data that they collect from the platform, is decidedly superior to the credit rating models built otherwise through the Credit Information Bureau data and through the soft information which a bank has. Now, these studies are in initial stages in the sense that this is a developing area. Apart from that, the issues also are twofold. Issues are there. One is that the data monopoly virtually, first of all, to whom the data belongs is not very well defined so far. The big techs have a lot of monopoly on this data. And therefore, in order to reduce their power and in order to empower the other financial sector entities, the exchange of data is something which is on which actually the work is going on. For example, open banking, that is already there. Then you have in Europe, you have GDPR and all those things. But this is again a complex issue because if raw data is to be shared, that's fine. But if analytical data is to be shared, then that becomes a problem because then the incentive to analyze data goes away from the entity which has the capability. The third issue, which is quite nascent in this area, is that when you rely on technology and data too much, then the relationship becomes weak. You start looking only at data. And that is where there is an apprehension that the new form of credit dispensation coming through fintech and big tech, how it will behave during a downturn, there is a serious question mark on that because there is no relationship banking. So to sum up on this issue, I would say that definitely heavy use of technology, but exercise your judgment, exercise maintain your relationship, do the hand holding during stress period. These would be the solutions. But at the same time, the question of proper distribution of data from data generators is something which is a very complex issue. And this is not going to be solved very easily. So this will be my my take or my additional comments on this particular issue of bridging the gap between lending institutions and borrowers. Now, let me talk about the broader issues from a regulator's perspective. Given the COVID situation, the situation in the Indian banking system and financial system, and where are we and in which direction we should be moving, according to me. So today we are not in a business as usual situation, but in a special situation caused by a global pandemic whose trajectory is still very uncertain. It is of paramount importance to discuss how our financial resources be put to best use under these circumstances and how we rebuild the trust between the lending institutions and borrowers for sustainable growth of the economy at a sufficiently high level, let's say 7% plus, to recoup the underperformance of the last couple of years with a reasonable within a reasonable time, as well as maintain it to meet the aspirations of essentially a young country. Now, in the recent monetary policy, we have seen that the estimate for this year's growth is negative 9.5, and the IMF estimate is negative 10 or negative 10.5 with a sharp recovery of 8.8% in the next year. But one has to realize that even with 8.8%, we will not even reach the 2020-21 levels. And if you add to that the fact that our growth has been sub 7% in the last couple of years or so, we seem to have some kind of permanent loss, which can be recouped only through a much higher rate of growth. So this is the challenge that we are facing. And in the wake of this challenge, for the financial sector to perform very well is extremely important. The coronavirus pandemic has, of course, thrown up lots of problems and challenges for all borrowers, including corporate borrowers and lending institutions, not only in India, but all across the globe. Unlike the global financial crisis, its origin is completely exogenous to the economy and the financial system, and its devastating effects again, unlike global financial crisis, have engulfed the entire world and with more severity. In fact, no other shock in modern times, including the Great Depression, has hit the economy on a global scale as bad. The lockdowns have led to historic contractions in real GDP in the second quarter of 2020, with India clocking the sharpest contraction at about 24%. Although the global economy as well as our economy seem to have troughed, the outlook is highly uncertain due to the possibility of a second wave, which already seems to have happened in Europe. Despite the unprecedented contraction in economic activity, defaults and bankruptcies have stayed low due to massive fiscal and monetary support and regulatory accommodation and their unprecedented coordinated response. It should be noted that the banking system in general, though not true for India, was much better capitalized going into the pandemic-induced crisis, largely due to the post-global financial crisis reforms, as a result of which they could draw on their capital buffers to keep credit flowing. Governments in many countries have undertaken significant non-budgetary measures to support the business sector via loan guarantees and direct equity injections, in addition to budgetary fiscal stimulus. Central banks have significantly expanded their balance sheets, mainly through purchase of government securities as also private sector assets. In many European countries, employment held up due to furlough schemes, but unemployment has risen in USA and EMEs due to absence of such support. These measures, including injection of massive liquidity, have stabilized the financial markets too. In fact, a bit too much, to the extent that there is a clear disconnect between the state of the economy and their uncertain prospects going forward and the valuation of risky financial assets. In India too, we have done a bit of most of these things, but we have had severe constraints, particularly in the fiscal and regulatory spaces. Monetary policy and operations have done the heavy lifting because with policy rates at 4%, there is still adequate space available for further easing unless the economy is spooked by high inflation, which by present estimates looks unlikely. Generally speaking, RBI's monetary operations have been with a view to providing ample liquidity to the banking system at a lower cost, to encourage banks to provide liquidity to NBFCs in particular, as well as to corporates, and lately, such operations are to target certain productive segments of the economy. RBI has also undertaken OMO and switch operations to maintain orderly conditions in the financial markets and facilitate very large government borrowings at a reasonable cost. In fact, the borrowing cost to the government in H1 of financial year 2021 is 5.82%, which is the lowest in the last 16 years. This is remarkable, considering that 67% of the projected government borrowings of a very large borrowing program of rupees 12 trillion for financial year 2021 was completed in H1. It is also going to undertake OMOs in state development loans for the first time to help easing of yields on state borrowings. To increase banks' appetite for government paper, relaxations in HTM portfolio of banks has also been extended. Fiscal measures have been limited due to resource constraints, but to tackle risk aversion of banks, certain direct support measures to businesses, MSMEs, and NBFCs have been extended by the government. For example, emergency credit lines to businesses, MSMEs with partial government guarantee, equity support to MSMEs by way of subordinated debt and through funds of funds, and rupees 30,000 crore special liquidity scheme for NBFCs, HFCs, and MFIs. In the regulatory domain, apart from certain measures to ease the cost, such as reduction in risk weights, etc., the main thrust has been on providing relief to the corona-affected businesses by way of moratorium of 6 months and a special restructuring scheme for businesses affected by the pandemic, but were not overdue in their liabilities of more than 30 days on March 1, 2020. The restructuring scheme, which has the feature of allowing the asset classification to remain as standard on restructuring, contrary to the regulations at present, is by design cautious given the severe problems in which the banking system had landed due to the mishandling of the earlier restructuring regime, from which the banking system is still reeling. And all the efforts at improvement in the earlier situation are set to roll back completely when the corona hit defaults and bankruptcies inevitably surface, both from these special restructurings as well as from restructuring under the normal regulations. In fact, the RBI Financial Stability Report states that the gross NPAs at 8.5% in March 2020 are set to rise to 12 point something in the stress scenario on account of COVID, and to 14 point something, 14.7 if I remember correctly, in a severe stress scenario. Now we do not know what is going to crystallize, particularly in view of the apprehensions about the second wave in winter. So we have to keep our fingers crossed onto what is going to happen to the asset quality. The regulatory measures announced have, as expected, resulted in demands for more relief. One is of waiver of interest on interest for those who opted for moratorium. This is a vexed question, as on one hand, there is a plea for relief, justifiable in many cases, and on the other hand, it has moral hazard, as well as implications for credit discipline and health of banks, in case they have to pick the tab. The ideal solution, in my view, would be to accommodate the stress through restructuring. However, the case is with Supreme Court. While the hearings on the matter will continue and a final verdict is some time away, the apex court, it would appear, is comfortable with the idea of the government picking up the tab of the loss banks would incur by not charging the compound interest on exposures that were allowed a moratorium. The decision would come as a huge relief for both banks and the Reserve Bank of India. While there were no specific statements to this effect, it would appear from the apex court's observations that it is not going to recommend a waiver of compound interest for bigger exposures of more than the strict rate. In other words, the government will reimburse banks for compound interest due only from small borrowers, and the fiscal burden appears to be manageable. The other requests I understand are related to easing the eligibility criteria for special restructuring, though I'm not aware of what is the decision on that or whether a decision is yet to be taken. The important thing while effecting restructuring is to be aware of doing, is to be wary of doing too little or too much. The cost of doing too little would be disastrous, as it will destroy potentially viable businesses with heavy cost to economy and employment. The cost of doing too much would be returning to history, and it will be potentially equally disastrous, but its crippling effects would surface only after some time, as has happened with the earlier restructurings. Restructuring will also have to reckon with some permanent changes that may happen in business models and personal choices, having an implication for viability of some of the pre-COVID business models. This by no means is going to be an easy task. What is therefore required is honest and ethical approach to restructurings. Judgmental mistakes will inevitably happen, but if the exercise is done in the right spirit, with integrity, such deviations from the assumptions and projections would be within limits and not cause systemic issues. Going forward, the challenge that lies ahead for both the lending institutions and borrowers is to understand the new trends, their impact on the lending relationship, and successfully find solutions to create a constructive and healthy relationship between the lending institutions and the borrowers. Let me now point to a more fundamental issue, and this is the concluding part of what I want to say. The fact is that the financial system, that is banks and NBFCs, have had serious fault lines from much prior to COVID. And therefore, we have to think of structural changes and reforms even after Corona goes away. This does not need any elaboration. There has been deficit in capital buffers and corporate governance. The system is gripped with extreme risk aversion, both due to lack of adequate capital buffers, as well as the fear of investigation if business decisions go wrong. As regards capital, let me illustrate. As per a BIS report, that is Bank for International Settlement Reports of May 2020. This is a report in the context of COVID. Banks globally entered the COVID-19 crisis with roughly US dollars 5 trillion of capital. 5 trillion of capital over and above the Pillar 1 regulatory requirements. As per the survey of about 5,600 banks globally from 142 countries, the common equity tier 1 capital ratio was 14%, whereas this was 11.7% for the Indian banking system. And as you know, there would be a skewed distribution within the system. A much lower common equity tier 1 and heavy load of NPAs would together make it much more difficult for the Indian banks to push credit into the economy, and this is what we have been seeing. So all the TLTROs and everything that has been done hasn't really had the desired effect in terms of flow of liquidity because of apprehensions about the sovereign, the quality of the institutions and the quality of the corporates. It was this very comfortable capital level globally which has enabled banks to continue to lend with regulators' encouragement despite the fact that some risk aversion would have set in due to pandemic. So therefore, a deep set of reforms is required in the Indian banking system, more particularly as we all know about the public sector banks, which will enable the Indian banks to play their part effectively in realizing the Indian dream. I do not want to go into the issues of reform or reform measures. There is already a model existing in terms of MAC committee, and there could be several variations, but that is something which will take another day. So I would like to conclude my address and would request Shri Seshadri, our session moderator, to kindly carry forward the discussion. Thank you.
Thank you, sir. Thank you. That was a extraordinarily well thought out address. It brings out so many aspects that I think we were remiss in not touching upon. You mentioned that there is a need for ethical values that are appropriate ethical values to permeate both the lender as well as the borrower, so that some of this can be resolved. In addition, you talked about appropriate methods of doing credit decisioning. You talked about credit scoring models where information that is currently being used by the large technology companies appears to work better than the credit scoring models that the banks are using. However, on that particular one, perhaps both models are backward looking, and essentially the uncertainty that has come out because of COVID perhaps would not have been dealt with by either model is something that we probably will have to discuss. In addition, you talked about the goals of society, which needs to be appropriately bridged both by the lender and by the borrower. And you talked about the fact that some of the costs of ensuring that social goals are met are being actually taken by the government, as in the case of the interest upon interest. There was the discussion on when we were having our panel discussion, there were discussions on the need for a development bank and the fact that banks had stepped into the roles of into the shoes of the development bank, and some of the issues that banks are facing today are on account of the loans that they made in the absence of a development banking institution in the country. I think maybe the extreme risk aversion that we are seeing today would probably have been moderated to a degree if those loans were not on the bank's books. Something that we perhaps can debate on another day. When we have you here with us, Mr. Sinha, we just wanted to ask you one question. Would a discounted funding window at the RBI be possible? Because there is this need to restructure a whole range of loans, and the borrowers are in no position to pay current market rates. Would if banks were to restructure them at lower rates, that would only be possible if a discounted funding window is available. I understand that there are limitations to what the RBI can do, and but is something of this nature possible, even in the realm of can we think about something of this nature so that borrowing entities that are facing grave difficulty, but which are required to keep employment and other aspects, keeping all of that in mind, we want to keep them alive. Would something like this be even within the realm of the something that we can think about?
Well, I can't give an authoritative answer to this. Standing on my feet, first of all, I'm not sure whether there is any provision, legal provision available for this. But going by the objective, in spite of limitations, whether legal or otherwise, if it is an idea which is good for the economy, certainly it should be pursued, I would say. Whether the subvention comes from RBI window or whether it comes from government. I mean, if it is useful for the economy, by all means explore it. But can't give an authoritative answer from RBI perspective.
My apologies for throwing that at you in without clearing it with you earlier. But let me thank you very much, Mr. Sinha. You've been very kind. It was a wonderful session. I want to thank everybody on the panel. I want to thank Mr. Sinha for taking the time to be here with us. I want to thank everybody who has attended. I want to most importantly thank the ASSOCHAM team, Dr. Singh and his colleagues who have made this possible. Thank you, everybody. Thank you very much. We will try and summarize what we just discussed and circulate it to everybody within the next few days. So thank you once again for taking the time, and it's been a scintillating discussion. Thank you very much.
Thank you, Mr. Sakani.
Thank you, everyone.
Thank you, everyone.
Thank you.
Nice talking to you. Nice listening to you.
Thank you very much.
Thank you, sir. Thank you, Seshadri sir. Thank you. Thank you, Sinha sir. Thank you.